Well, hello, members, and welcome to this week's show. It's April 24th, this weekly review. Take a look at what happened, what we think may happen. You know, last week we saw the same sort of thing we've seen before, and that is as these markets just continue to try to grind higher. We did have a little setback here on the NASDAQ. As you know, we had some earnings hits on the big cap, in particular Microsoft and Google. But overall, the market just keeps grinding. The Russell actually finally goes positive on the year. And, I'll try to be concise and quick here. This week we're going to see some movement. I suspect we've got the Fed and the Bank of Japan this week. Currencies, to me, are a big part of what's happening out here. And I know this is getting old, but this market will correct. And in a way, it is correcting. So far, it's correcting by time, not price. That's what we've seen, in general. If we pull up the S&P and take a look at it, you'll see what I'm talking about. S&P slowly pulling back. You're kind of getting this grind sideways. What you're not getting on the S&P, you're getting elsewhere, though, in terms of the correction. And that is, if you look here at the NASDAQ, let's grab that chart, is that we're getting some sort of a correction in terms of time here, whereas it's not as visible elsewhere. So, what I'm saying is, if you draw the lines and you pull up a range, you've got a range that's really began to form now. And again, going back to this bar, we can talk about this time frame. So it's almost a month of pretty much sideways action in the NASDAQ. And even though we don't see it elsewhere, we're definitely seeing it here. Pull over the weekly chart. You can see congestion right at the top of this breakdown bar. And though it hasn't began to really affect price that much, it certainly has affected it in the sense that it's not going up and up and up like it had been doing prior to this. The one thing I've emphasized over and over is that when we do finally get the selling, right, that selling is most likely going to be met with buying. You don't get this kind of a move without the buyers coming in on the first dip. And we haven't had a dip. I mean, we've only had 2 days, 3 back-to-back 2-day sessions down on the S&P throughout this entire move. And so you cannot expect that those buyers are simply going to disappear and not think that there's a reason to come back in. The thing that I would note that's starting to happen here that hasn't happened is that the stocks that are moving from bearish to sideways to bullish is actually declining. And so you're starting to see divergence inside the internals in terms of qualified trend. And that, to me, that weakening, again, is a sign of what's coming. Despite that, we haven't really had any significant divergences yet, right, that would suggest that we're definitely going to get a pullback. In other words, we had some over-under bars on the indexes, most notably the ones that didn't have the volume characteristics that you'd want, but they were over and under, and they actually did lead to a pullback. That's not necessarily what should happen, and so that's a sign of some sort of a weakness in my mind. The fact that you don't get the great setup yet, you do get a little bit of a pullback. And after the over-unders on the indexes, the very next day we got it on many of the sectors, like the financials here Thursday, along with other sectors like the discretionary and so forth. And finally, even though we've seen some improvement in Europe, we're definitely not seeing it in Asia outside of Japan. And again, these are currency issues because the dollar had been holding lower, now starting to move back up. That's making the Japanese yen, the euro, cheaper. And Asia, of course, is feeling the effects of that. Shanghai in particular, you can see on that Shanghai chart, not only the inability to move higher, right, but actually to come down with some gusto one more time back into these swing point highs that were broken. This is the second trip back. Probabilities increasing that this is actually going to try and trade down again. And so you've got problems in China. Again, all this currency related in my mind. And, as long as the Fed has to be the balancing act, it's going to be take some off, take some, put some on. in terms of strength of the dollar, weakness of the dollar. And that's the only way these countries, in terms of currencies, continue to bounce up and to bounce down and to maintain. An interesting tidbit I ran across this week that you probably would be interested in is just the amount of debt that's been thrown into the system in China, right, to stop this decline. 40% of the GDP, over $4 trillion of new debt in the first quarter alone. That's how much debt's being punched out in the Chinese economy to try to get it to move higher. What's the negatives, right? There's a number of them still out here. The ones that are most visible, technically, these long tails that are just starting to form. Now, it doesn't mean that they're going to, make this market come down immediately. It's not the way it works. Certainly, what we can see or should see, and I'm going to pull over the S&P 500 chart here as it comes up, is we should see continued pressure as these tails start to form. So in other words, those indexes that are unwilling to give it up, once they start forming the long tails, typically they're going to try and come back the other way. Here was one at the top the last time we made the move up. Then we had all the bouncing that took place, and then another long tail before we got a big move down. We finally got another long tail taking place here. We'll see if that in fact turns out to be some sort of a signal for us. Another way to look at what happens or is happening is to look over at the qualified trends, right? The short-term trends have stayed bullish for quite a while now, and we'll look at that in a second. But what it's led to is health coming back into the intermediate term trends, and that is what happens. That's the way it works, right? It goes from left to right. You stay here strong enough, long enough, you'll improve this side of it. If you're weak long enough, you'll decrease the strength in the intermediate term. Remember, most of these were bearish. Almost all of them are bullish now. Also note that those things that used to be bullish now have turned bearish. For example, the utilities are bearish on the short-term time frame. The healthcare, not the healthcare, but the consumer staples have gone bearish. You've had a flip in risk on versus risk off. It's shown here on the qualified trends. Flipping over to the health, in terms of how this looks, and just so you know how I get to these things, the qualified trends is here on resources, current market trends. If you want to get to this particular page, you just come down to Trading Cube Scanner and you can put in a scan, and you can actually get all the MTTFs so that you can look at those. And when you look at the MTTFs, what's happening? Well, we've been long enough and strong enough that now these are starting to push towards the extended, and so the indexes themselves are becoming extended. When that happens, what happens? Well, they usually have to change trend, right? When you get up around 70 up to 80, that's usually getting extended, and that's what you're starting to see here across the board in all of these. On the intermediate term time frame, you're also extended on the sideways, saying that it's either going to break up or break down at some point in the not too distant future. But you actually have bullishness, and just this bullishness taking place on these trends, right, which suggests that maybe that break may be to the upside once this resets. Now, what does it mean for that to reset, right? And you can also see it in the sectors. So if we pull down to the sectors, you can see the extendedness here in the consumer discretionary. You can see it in the industrials. You can see it in the basic materials. You can see it in the chips themselves and so forth. And so you can see extensions starting to form that is probably going to lead to some sort of a setback. And if we move back over to the chart and say, what would it mean to get some sort of a reset, right? Well, that means you have to break a swing point low if you're bullish. And that's what we were just looking at. That means you'd have to come down here and break some of these swing point lows on the daily time frame. Just another hint that we're probably getting to a point where we're finally going to get some sort of a pullback again in the not too distant future. What else? There's some other things that have happened here. Test failures on the weeklies, on the NASDAQ, NDX. So what I'm looking at here is the breakdown bar right in this area. We came into that area, right, and as we came into it, we actually kind of failed, went up on volume, less volume comparatively, right? And test failed at that area. The other thing you'll note here is you actually went over and under, but again, just like the S&P and the other indexes last week, on the dailies you actually had more volume, so that's not a very good read. If this does pull back one more time, it's suggesting that things are stretched and wanting to reset a little bit. And finally, the strongest index has been the Russell, right? This thing's been powering higher, but now the Russell's main drivers, which are the financial small cap financials, those stocks are starting to get up to areas that are going to give them resistance. So let's take a look at that real quick. Here's the Russell. You can see the power higher. And if we go look at the stocks inside of it that are doing most of the moving, it has been the KBE and the KRE. I'll just look at one of them. Here's the KBE. I'm going to flip it to a weekly. You see the swing point highs broken, leads to a nice stretch up. Here it is coming into its resistance zone. It's also got a bearish retest regen zone, or two of them, that it's working off of. One it's just coming into now, which is the first trip back after more than 6 bars, right? So that should give it resistance. And then there's this one that it came back into and also overlaps. And so we've got this area here that should be a difficult area. Again, should be. As always in neoclassical, what we're asking is what should happen, shouldn't happen. You've actually got an ABCD structure. If you do the numbers and push it in here and take a look at it, that ABCD structure points into that area. So we'll see how that behaves. If it starts to cool off, I would think the Russell is going to do the same. And just some background information you can look at, but the yield-hungry investors are everywhere. You can't get yield anywhere, anything that's safe. Argentina, the perennial defaulter, right? They had a debt offering last week, and the yield-hungry investors went after this thing. They oversubscribed to it. It paid 7%, and you can imagine 7% in this environment is a huge amount of money. They leverage up, they go buy it, and you can just see that regardless of the credit worthiness, investors are interested in pushing for yield wherever it is. Junk bonds, same thing. Now junk bonds are starting to come into resistance. So let's look at those. And what we're talking about here is what we were just looking at on the KBE, KRE, and that is that you're coming back in after more than 6 bars to the top of the breakdown bar, right, and to anchored resistance. And so you're coming into that bar, you're coming into the zone. Everything here lines up that this should be a difficult spot to try and get over. Again, that's something we need to watch and evaluate to give us more clues. But if anything, once more, this should be a difficult area. And if the junk isn't going to be bought, then typically the market's not going to be doing as well. Of course, the big news this week is going to be the Fed and the Bank of Japan, in particular the Fed. The Fed is the good cop, bad cop right now. What I'm talking about here with the Fed is this good cop, bad cop routine is that, the Fed seems to be the balancing act anymore. They're kind of the balancing master. They are taking and moving the dollar through their rhetoric, just like Draghi used to move the ECB or the euro through their rhetoric, and they're allowing the world markets to gravitate higher overall, even though they can't do them in unison. For example, if you do something that helps Europe, you're typically hurting Shanghai. If you do something that helps Shanghai, you're hurting Japan, and so forth. And so this dollar, if you look at the dollar itself, and take a look at the move up over the last few days into the Fed meeting, and then pull it back and look at it on the range. Right now, the dollar is holding this range, and if we pull the monthly over, you can see the range here. I'll just draw it in as I talk. And that range being held, right, is, I think, a reflection of the Federal Reserve's talk. They push it down, they push it up, they allow the markets to hold, yet they don't, when they do push it up, they don't drive the markets down that much. And so it's this balancing act between us and the rest of the world that seemingly continues to take place with respect to the Fed. If you look elsewhere, like gold's still range bound. The bonds on a weekly basis, they're not moving. Here's a weekly basis of those. The big spike up, you're back down to it, you're coming back into the swing point high again. If you look at it on the monthly, it's the same thing. The large bar here, it's in the middle of it, right? Still range bound, and you can draw the ranges in, but it's the same across all of these tells in that you have pretty much ranges that are in effect and still holding, and really not deviating that much from those ranges. And that's a reflection of the market too. I mean, if we pull the market back and look at the market itself, and I'll use the S&P 500 here to do it, you're going to see the same sort of thing here that you're seeing in all these other charts, and that is a range-bound market that continues to be range-bound, and a huge part of that is a reflection of what the Fed is doing in its balancing act along the lines of keeping all the markets in their respective ranges, and trying to allow, in my opinion, trying to allow time to do what they can't do, and that is to take care of all this debt that's out there that's bad. So what's the bottom line? We've had our first set of earnings disappointments last week. The market's held higher, but you can see that weakness starting to come into them, given what I've shown you already. Apple's the last of the big caps going to report on Tuesday. Then you've got the Fed and the Bank of Japan on Wednesday. That's going to put a lot of pressure on Wednesday as a result of those three events. So Wednesday's the big pivotal day, either up or down. I think that's where you're going to see all your volatility as these currencies start to move, and as Apple either tries to push higher or lower. Apple typically moves 4 to 5% on earnings report. So far, this market's correcting by time, but I suspect price is likely on its way, and when it does, I also suspect it's going to be bought, just like I've talked about. Last week, the scenarios played out pretty much as described, both the best case and the likely case. This week, if I look at the best case, it would be that the small caps really just continue to surge, that KRE, KBE continue to push up. I don't expect that, but that would be the best case. Worst case, the NASDAQ NDX, as a result of Apple, maybe the Fed, really start to tank, and they go break those sweep point lows that are down. There's a couple of them. On the likely case, continued divergence, probably rollover with the S&P. I would think this level is the first level to watch on the way back down. Okay, that's it for this week. Gives you a pretty good feel for where things are. End of the month, May usually is that May, sell in May and go away. We'll see if this week tends to, or starts to set that move up. It's been quite a ride, right? Huge thrust down to January, February, back up, and now hanging again. Till next time, take care. Bye.